more than you should. At Consumer Cellular, there's nothing to hunt down. We're built for people 50 plus with plans starting at just $20. And our 100% US-based customer service actually answers the phone. Call 1-888-FREEDOM or visit consumercellular.com today and get your second month free for a limited time.
Taxes, fees, and other third-party charges will apply. See website for additional details.
This is the Money Matters Radio Network, WBNW 1120 AM and W275CM FM, Concord, Boston. The Money Matters Radio Network.
Our Senators Edward Markey and Elizabeth Warren and Representative Jake Auchincloss are standing up for radio listeners like us by supporting legislation to keep AM radio in cars. They know the value of local radio in times of emergency. Now it's time for Congress to finish the job and pass the AM Radio for Every Vehicle Act. Learn more at dependonam.com. This message furnished by the National Association of Broadcasters and this station.
When a heart stops, the clock starts. You are the first responder until help arrives. In that moment, 4 minutes equals brain damage. 6 minutes equals too late in an emergency. The first responder is you. We need you. Will you be ready? Learn CPR. Visit heart.org/nation. That's heart.org/nation.
Let's talk LDL. AKA bad cholesterol. The higher your LDL cholesterol, the higher your risk of a heart attack or stroke. Your health matters. Know your number. Talk to your doctor and get your cholesterol checked. And learn how to help lower your LDL bad cholesterol. Because your health is in your hands. Find out more at heart.org/LDL.
As a busy mom, my to-do list is full.
While we can't add more hours to the day, we do have a great resource to help.
Go Red for Women has information to help you and your family live a healthier life.
Visit goredforwomen.org/momlife today.
As you navigate life after divorce, planning for your family's future becomes even more important. Hi, this is Mike Armstrong from the Armstrong Advisory Group. From everyday expenses to thinking about how college will be funded, it's important to have a clear plan for how all of your upcoming costs will be handled over time. Divorce also means adjusting to a new financial reality, where one household becomes two and your budget, saving strategy, and long-term goals may need to be reevaluated. Our new guide is called Divorce and Your Financial Plan, and it discusses ways to build a financial strategy that supports your family's next chapter. You can get your free guide today by calling 800-393-4001. That's 800-393-4001, or you can request the guide online at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
This is Tucker Silva of the Financial Exchange Show, and I'm joined today by estate planning attorney Todd Lutzke from the law firm of Cushing & Dolan with your Financial Exchange quick tip of the day. And today, we're talking about the use of life estates and your primary residence. Todd, what are the pitfalls associated with creating a life estate when you transfer the remainder interest to your children?
Yeah, this is the most common way people create life estates. It seems easy, it seems simple, but it's not the best way to create a life estate. Once you put your children's name on the deed, you give up a lot of control. Like you can't change your mind later if you want to leave it to one child versus another who might be taking care of you later. You have problems if you want to go to sell it, right? You might have the right to live there, but if you want to go to sell it, you're going to need the permission of the children in order to sign off on the remainder interest of the deed. And then even if they do sell it and you get their permission, a larger chunk of the proceeds are going to end up in the hands of the child rather than you. That creates adverse income tax consequences to the child. Plus, you who sold the house might need the money to buy another house or a downsized house or move, all of which create problems. Never mind creditor problems for the children while they're living. Folks, don't do the life estate this way because it seems to create more trouble than it's worth.
Learn how you can avoid probate, eliminate estate taxes, keep your money in your family, and protect your assets from the nursing home. Request this brand new guide from Cushing & Dolan. It's called Calculating the Consequences of a Life Estate. Call 866-848-5699. That's 866-848-5699. Or you can simply request it from their website, legalexchangeshow.com.
The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and/or Armstrong Advisory may contact you offering legal or investment services. Cushing and Armstrong do not endorse each other and are not affiliated. The Financial Exchange is produced by Money Matters Radio and is hosted by employees of the Armstrong Advisory Group, a registered investment advisor. All opinions expressed are solely those of the hosts, do not reflect the opinions of Armstrong Advisory or anyone else. Investments can lose money. This program does not offer any specific financial or investment advice. Please consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong Advisory and the advertisers heard on this program do not endorse each other or their services. Armstrong and Money Matters Radio do not compensate each other for referrals and are not affiliated. This is the Financial Exchange with Chuck Zodda and Mike Armstrong. Your exclusive look at business and financial news affecting your day, your city, your world. Stay informed and up to date about economic and market trends, plus breaking business news every day. The Financial Exchange is a proud partner of the Disabled American Veterans Department of Massachusetts. Help us support our great American heroes by visiting dav5k.boston and making a donation today. This is the Financial Exchange with Chuck Zodda and Mike Armstrong.
Chuck, Mike, and Tucker with you, and as we continue through the week, top story remains the same, continuing to watch closely what is going on in the Middle East for signs of a change from how things have been for the last 4 weeks now. Tomorrow is going to be the official 4-week mark of the conflict in the Middle East, and so you know, we're getting to the point now where, depending on how much longer this moves, or how much longer this goes on, the knock-on effects from the lack of energy products and other commodities transiting the Strait of Hormuz becomes larger. This is something that we've said since the beginning, that every day this goes on, the economic damage is going to become more challenging to overcome. And so as we get to this point, it's clear to me, and this piece from the Wall Street Journal kind of echoes it, that the White House would prefer to have this thing, kind of done and dusted at this point. Would like to have operations wrapped up, but the question is, can you wrap operations up with a sufficient resolution as far as what any kind of settlement at the end of this looks like? And that's something that you can't necessarily put a timetable on if you really want to prioritize getting the best outcome versus moving as quickly as possible.
Yeah, I continue to go back to, I don't know how you possibly price the risk of this continuing versus ceasing. I'm willing to say that when you have headlines like the one that I'm seeing on Bloomberg right now, where Iran claims to have officially responded to the 15-point ceasefire and is now putting it back in the U.S.'s hands, I suppose that leads me to believe that this is closer to a resolution than we were a week ago. But that could still mean many months out, and it could mean nothing that they have responded to this. And the other headline that I just saw is that they're accusing the United States of deception. And so,
well, that was their response.
Right. The response was, this is deception. And it's, again, do I take that as encouraging that at least there are words being exchanged? I guess, but it is impossible for me, or I think anybody else, to price the risk of that being meaningless. And as we keep saying, the only thing that really matters is, do boats start moving through the strait? So it's interesting to talk about these things. Markets are reacting pretty substantially, minute by minute, on the headlines of who's speaking and when. But, I keep going back to, I just don't know what to do with that information.
And my answer continues to be the same thing it's been all along. You don't really do anything with it. Look, here's the thing that here's the way the market psychology is set up right now, and this goes back to basically exactly a year ago. And this is why this has been my view since this started. I asked you a couple weeks ago, Mike, what's been the single most powerful force in markets over the last 14 months? And my answer was President Trump, and specifically the day after, not the day after, 2 days after, two trading days after, when the Liberation Day tariffs were repealed, the S&P 500 went up 9.5% in a single day.
Yep.
I am convinced, more than ever after watching how this market has moved for the last 4 weeks, that single event has changed the psychology of market participants to, I can't miss that next time when that happens. But in doing so, are you preventing that next time from actually happening because the market can't fall in response to bad news before rallying?
Right.
And so it's kind of short-circuited the market's approach to managing risk because no one wants to miss when there's a solution that's announced and the market rallies. But if the market hasn't really fallen that far, can that rally happen? And just to take you back a year ago, because again, I think this is informative just for talking about where we are right now. On the day after Liberation Day, so the day before, the S&P closed at 5670. The day after went down to 5396. It was about a 4% fall on Friday, April 3rd. Thursday, April 3rd. We then came in on Friday, and the market took another 8% down move to 7% down move to around 5,074. It then, for the next couple days, bounced all the way as low. It got down to 4910. Actually, intraday, it got down to 48.35. So in the days after Liberation Day, we saw a move from 5,700 to 4,800. That's almost a 20% move in a span of 3 to 4 days.
Right.
And then you had that big 9.5% rally that kicked off, the subsequent 6-month rally from late April through early October. And so investors don't want to miss that, and I totally understand. But if you have a market that has very, very begrudgingly fallen 4% over the course of a month instead of 4% the day after the tariff announcement, it suggests to me that investors are more nervous about missing upside right now than pricing in potential downside. And I'm not saying that's wrong. Maybe that is the right approach because that downside can be, managed in certain ways. I don't know. I'm not saying that's inherently wrong or anything. But what I am telling you is, if at any other point in time with anyone else in the White House, you'd tell me, hey guys, Strait of Hormuz is closed for a month. What's the market response? It's
30.
not 4% down.
Yeah.
I got to be honest with you.
Yeah.
So markets are betting on President Trump being able to navigate this to a conclusion that avoids those worst case outcomes. And maybe that is the right answer. I don't know. But this is not a market that is poised for a 10% rally the day that a solution is announced, in my opinion. Now, of course, I'll end up being wrong, and the market's going to go up to 7,200 the day after.
My answer is I have no idea. I suppose. But you're right. I keep getting
the reason most big updates, the reason why you always hear if you miss the biggest updays in markets each year, you'd miss so many of the returns, is they usually happen when things have gotten really bad.
Right.
And then the recovery is when you see those big updays. If the market is 6% off its all-time high, I don't know, do you get the 9.5% update then? It strikes me as challenging, at least.
I would think so. My counterpoint, Chuck, would be I have probably not listeners to this show on a daily basis, but I have gotten a multitude of emails, calls, and otherwise questions about, hey, markets are getting hammered. Is now the time to do it? And I think if you do not actually look at the numbers and you just follow the headlines, you might be inclined to believe that the market has gotten hammered on the news. Every headline is about how the S&P has sank, third week in a row of down markets. But to your point, it's resulted in a market that is less than 7% off of its all-time highs and less than 5% off of the pre-war highs. So my point would be, I don't know. Maybe there are a whole bunch of people that jump into markets because they perceive they have been down and hammered because of the events in Iran.
Now, I will say, like on a micro level, again, this has been the story for the last 5-6 months now. If you look at what's happened since the start of the month, you can look at parts of this market and be like, ooh, that's pretty gross. You know, like you take a look at Google and Meta just as an example. They're both down around 10%. I don't think Google and Meta are particularly tied to the outcome in the Middle East, but they're still down, about 10%. You got a bunch of healthcare companies down around 10%. You go through the industrial space, and you've got, GE off 15% since the start of the month, Boeing off 13%. You've got, who else? Parker Hannifin's down 10%. You go to, consumer cyclicals. Home Depot and Lowe's are both down more than 10% since the start of the month. Home builders have gotten wrecked. Even like you look at your safe things, things that people think of as safe. Procter & Gamble's off 14%. Clorox is off 14%. Clorox is off 17%. So, like, you go through the individual names and you're like, yeah, it's been kind of grim for a lot of them, but there have been pockets of the market that have somehow held up, energy being the biggest one, obviously, but software's had an overall bounce back after a really bad January and February. You've got, companies that have rallied in that area. And so, the S&P 500, if you take a look at it and say, gee, like, how's the S&P actually done, over the last, month, which, again, includes, some time before, S&P's off around 5.5% during that time, which is, I'm not saying that's like, hey, great, but it's not even correction territory.
Right.
Like the wheels are not falling off the bus. It's just the bus is kind of on, bumpy territory, bumpy terrain right now. So we'll see where things go here. Again, I think ultimately the next 10 days are pretty pivotal just because, like, you get to that point, and again, every day the impacts worsen, but B, it's, hey, you're going to have those Marines in theater right now. You're going to have, some of those additional forces there. What happens in terms of, is this a negotiating ploy? Is this actually, some action that's coming? We're getting to a pretty pivotal point in this, and I think within the next 10 days is going to be a pretty important period to watch because, as I've been saying all along, the actions are going to make this thing, not the words. Don't pay attention to what each side is saying. Pay attention to what they're doing. Right now, they're still lobbing missiles and bombs at each other, and Hormuz remains largely closed aside from a few small exceptions here and there. Let's take a quick break, and when we return, let's talk a little bit about what we're seeing in energy markets. Is this going to be a short-term shock? Is it a longer-term one? We'll discuss after this.
Stay informed and prepared for market changes and breaking business news. The Financial Exchange is live every day on YouTube. Tune in, subscribe, and keep up to date on all of our show's content on a daily basis. This is the Financial Exchange Radio Network. Life estates are sometimes used to protect your home as part of your future, but it's important to understand how they really work before making any changes to your estate plan. Cushing & Dolan are experts in elder law and taxation. Their new guide, called Calculating the Consequences of Life Estates, explains the pros and cons and why careful planning is so critical. A life estate can allow you to remain in your home while transferring future ownership. But decisions like putting the property in your children's names versus using a trust can have very different consequences when it comes to taxes, control, and protection from creditors. Before you sign any deed or transfer property, be sure you understand your options. Call Cushing & Dolan at 866-848-5699 and ask for your free guide today. That's 866-848-5699. Or you can request the guide online by visiting LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
As you navigate life after divorce, planning for your family's future becomes even more important. Hi, this is Mike Armstrong from the Armstrong Advisory Group. From everyday expenses to thinking about how college will be funded, it's important to have a clear plan for how all of your upcoming costs will be handled over time. Divorce also means adjusting to a new financial reality, where one household becomes two and your budget, saving strategy, and long-term goals may need to be reevaluated. Our new guide is called Divorce in Your Financial Plan, and it discusses ways to build a financial strategy that supports your family's next chapter. You can get your free guide today by calling 800-393-4001. That's 800-393-4001, or you can request the guide online at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
It happens all over Massachusetts.
Can you tie my shoes?
In every home and every community.
Be careful on your bike.
Learning can happen anytime, anywhere.
We'll see you at practice this weekend.
And no matter how learning takes place in your family's life, DESE is there as your partner. The Massachusetts Department of Elementary and Secondary Education. Never stop learning. Find out more at mass.gov/back-to-school.
Sponsored by the Massachusetts Department for Elementary and Secondary Education.
Our Senators Edward Markey and Elizabeth Warren and Representative Jake Auchincloss are standing up for radio listeners like us by supporting legislation to keep AM radio in cars. They know the value of local radio in times of emergency. Now it's time for Congress to finish the job and pass the AM Radio for Every Vehicle Act. Learn more at dependonam.com. This message furnished by the National Association of Broadcasters and this station.
Environmental nonprofit Ocean River Institute is working with communities to tackle climate change with nature-based solutions that feature slowing water down and building more soil with grasses and plants. Research indicates that people acting in their own neighborhoods can build an inch of soil in a year and slow sea level rise down by as much as 25%. Please visit oceanriver.org for more information on opportunities to make a difference and go the distance for savvy stewardship of a greener and bluer planet Earth.
Here at the Massachusetts Department of Elementary and Secondary Education, we are committed to all students not only attending, but succeeding at school. Your presence is powerful. Share why you attend at doe.mass.edu.
Sponsored by the Massachusetts Department of Elementary and Secondary Education.
Text us at 617-362-1385 with your comments and questions about today's show, and let us know what you think about the stories we are covering. This is the Financial Exchange Radio Network.
The Financial Exchange is incredibly proud to be a partner of the Disabled American Veterans Department of Massachusetts. Planning is well underway for the 2026 DAV 5K. The event sold out in record time last year, so head to dav5k.boston for all the information about how you can participate this November or make a donation to support our great American heroes. Your gifts help fund free rides to medical appointments for veterans in the nation's first DAV-led housing initiative, providing homes for single veterans and veteran families. Go to dav5k.boston and make your donation today. That's dav5k.boston.
Mike, we got a piece here from the Wall Street Journal. Trump says the energy shock will be short-lived. CEOs paint a scarier picture. And specifically, it's talking about what we're seeing from oil and gas CEOs. And again, across, several of them, basically talking about what they see as the potential for longer disruption. So a couple of quotes here just that I'll put into the record, if you will. What they fail to understand is that the daily tweets driving volatility in both the commodity market and equity market isn't good for anyone. It's really just difficult to make any type of intelligent decisions in that environment. This is from Mark Viviana, who's a managing partner at Kimmeridge, who is an energy investment firm.
So is the way to read that no oil executive wants to pump additional oil based on the volatility we're seeing right now, even though it's strongly upward?
Yeah, it's something where, okay, like, they can't make concrete decisions because they don't know what the picture's going to look like 6, 12 months from now at a minimum, and longer term, 2, 3, 4 years. I mean, again, there are reasonable questions that I think if you're an energy executive, like let's say that you are considering, projects in the Middle East, just as an example, which, remember, U.S. energy companies partner with state-owned enterprises throughout the Middle East on a regular basis. The Qatar LNG plant that was hit last Wednesday, I think it was, not a U.S. firm that was a partner there, but Shell Oil. Royal Dutch Shell is a partner in that. There are Chevron and Exxon facilities in the region as well. If you're trying to, even if you're not talking about domestic production, even if you're talking about, hey, do we want to be a partner in, repairing, those refineries and this and that, questions that might be in your mind are, hey, what's the path going to look like for us being able to get ships out of the region?
Right. Is
Iran going to be, in a position where they think they're charging a toll for the foreseeable future? Are there still going to be sporadic, conflicts that break out, on a regular basis? These are questions that you ask in that region. And domestically, you're asking a different set of questions, which is, hey, prices are this way now, but given where global supply is going, kind of longer term, if we get back to that balance, remember, if you're talking about developing, oil projects, you're talking something that takes, years to happen and then a decade or so to actually pay off. This is a question where you sit there and you go, hey, I'm not willing to commit to anything long term right now because I don't know what the lay of the land is going to look like in 27, 8, 9, and 2030.
Right.
Other things that we have from Chevron's CEO, there are very real physical manifestations of the closure of the Strait of Hormuz that are working their way around the world and through the system that I don't think are fully priced in. That's from Chevron's CEO.
Should we talk about a few of those real, like the South Korea, the Philippines, what's actually happening in some of those places? I know we have talked about it, but with China banning fuel exports for all of March, South Korea...
Yes.
No driving gas-powered vehicles, or at least restrictions on gas-powered vehicles. Philippines allowing dirtier fuels. Laos cutting the number of days.
Same with Japan, yeah.
Children attend school. They've cut school to 3 days a week. Bangladesh, Pakistan closed universities and moved classes online. So we talk through everything through a very U.S.-centric focus, but this is the point that I've been making, is elsewhere in the world, they're already dramatically seeing the effects, and they're doing this. These preemptive measures that are being done are being made so that those economies can push energy to the most critical areas of their economy, which are generally manufacturing for most of those that we just listed. And that is where ultimately the U.S. could, I think, feel it, would be these places can't manufacture things.
The other place is the fact that, look, we're talking about energy right now, and I know that everyone loves to just talk about this as an energy shock. But it's a fertilizer shock. It is a plastic shock. It is an aluminum shock. Like, all of these things are made and produced in significant quantities throughout the Middle East and flow through to the rest of the world. And just as an example, Dow Chemical. Like, y'all are familiar with Dow Chemical. They're
yes.
They're
big.
Dow,
they're Dow Chemical.
They're Dow Chemical. Like, exactly. They came out, I think it was on Tuesday of this week, and they announced a 60% price hike on all their polyethylene products. Now, again, polyethylene, if you're not familiar with it, open your fridge. Everything in your fridge is packaged with some type of polyethylene.
Yeah.
And so you're talking about, 60% moving up there. Mike, I'm sitting in front of a laptop right now. Have to believe that there's all kinds of plastic polymers in it because I'm not just looking at a giant piece of metal. This is where this stuff hits the system as well, and it's not to say that the cost of your grapes are going to go up by 60% or the cost of your laptops will, but it's a combination of things. Number one, Dow also indicated, by the way, last week, they don't even know if they can source all of the polyethylene they need. They're not sure they can, and you're talking about one of the biggest chemical companies in the world, so part of this also might be, hey, we can only produce X number of, whatever's it is, be it, plastic bags or shrink wrap or, keyboard keys. These are going to be things that play in as well. Let's take a quick break, and when we return, Let's talk about private credit. We've done enough Middle East for now. We'll talk about what Lloyd Blankfein has to say about private credit next.
Like us on Facebook and follow us on Twitter @TFE Show. Breaking business news is always first, right here on the Financial Exchange Radio Network.
Our Senators Edward Markey and Elizabeth Warren and Representative Lori Trahan are standing up for radio listeners like us by supporting legislation to keep AM radio in cars. They know the value of local radio in times of emergency. Now it's time for Congress to finish the job and pass the AM Radio for Every Vehicle Act. Learn more at dependonam.com. This message furnished by the National Association of Broadcasters and this station.
Cardiovascular disease is the #1 killer of women,
taking the lives of 1 in 3.
That's more than all forms of cancer combined.
For too long, heart disease and stroke have taken the lives of the women we love.
But we're not giving up because we have something better,
stronger, more powerful.
We have each other.
When we come together and go red,
the more power we have against our greatest health threat.
Visit goredforwomen.org today to learn more.
Protecting your home at the life estate can be problematic if you don't understand the rules. Cushing & Dolan's new guide called Calculating the Consequences of Life Estates can help you learn about how this strategy works and what to consider. Call Cushing & Dolan at 866-848-5699 and get your guide today. Or request it online at legalexchangeshow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
Hi, I'm Michael Valila, Adjutant of the Disabled American Veterans Department of Massachusetts. The DAV of Massachusetts provides thousands of hours of voluntary services at our VA medical centers and soldiers' homes and is the only DAV department in the country to lead a veterans housing initiative for both single veterans and those with families. These programs are critical to serving our veterans in their time of need. You can help our great American heroes by making a donation today. Please visit dav5k.boston. That's dav5k.boston.
Let's talk LDL. AKA bad cholesterol. The higher your LDL cholesterol, the higher your risk of a heart attack or stroke. Your health matters. Know your number. Talk to your doctor and get your cholesterol checked. And learn how to help lower your LDL bad cholesterol. Because your health is in your hands. Find out more at heart.org/LDL.
When a heart stops, the clock starts. You are the first responder until help arrives. In that moment, 4 minutes equals brain damage. 6 minutes equals too late in an emergency. The first responder is you. We need you. Will you be ready? Learn CPR. Visit heart.org/nation. That's heart.org/nation.
This is Mike Armstrong and Paul Lane from the Armstrong Advisory Group out with our brand new guide for the month of March about divorce and your financial plan. And certainly while it's not the path that anybody hopes to go down with their marriage, many marriages do result in this, and it results in a full reformatting of their financial scenario. Now, Paul, understanding these different assets that ultimately need to get divided in the event of a divorce gets pretty complicated. So let's start with the basics when you're thinking about retirement assets versus the home versus, say, a checking account. How does one need to be thinking about these different buckets of money when they're talking about the equitable division of assets in a divorce?
Yeah, Mike, first you have to divide out those different assets into those buckets you were alluding to before: pre-tax retirement savings, real estate, as well as after-tax investment accounts. And what you have to understand is with the pre-tax retirement savings accounts, there are taxes and potentially penalties associated with those. So those assets are not equal to perhaps some money in a bank account, for example, that is much easier to access and withdraw. Same thing with real estate. Equity might be significant in a property, but there are a lot of carrying costs and expenses associated with that ownership.
Yeah, these things are complicated, and unfortunately, what it can lead to if you're not prepared for it is a division of assets that doesn't work out in your favor once you consider the after-tax implications of that division. If you have questions that you're facing as you head towards this life move, get your copy of our new guide, Divorce and Your Financial Plan. It's available by calling us at 800 800-393-4001. Again, it's the free guide, Divorcing Your Financial Plan, 800-393-4001.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. Time now for Wall Street Watch, tracking the stocks, the data, and the headlines driving markets so far today, right here on the Financial Exchange Radio Network.
Markets remain volatile as Wall Street keeps its focus on the war in Iran, where President Trump threatened to escalate the conflict after Iran rejected Washington's push for peace talks. As of an hour ago, Iran said it formally responded to the U.S. ceasefire plan. Right now, the Dow is up about 0.1%. S&P 500 down 0.4%. NASDAQ down about 0.7% or 149 points lower. Russell 2000 down about 0.25%. 10-year Treasury yield up 3 basis points at 4.362%. And oil up 3% higher, trading at $93 a barrel. Both Meta and Alphabet were recently dealt a blow in a landmark addiction trial where a LA jury found that Meta and YouTube were negligent for operating a product that harmed kids and teens and failed to warn about those dangers. Both Meta and Alphabet plan to appeal the verdict. Those stocks down 4% and 1% respectively. Meanwhile, several memory chip makers are seeing losses on the day after Google revealed its new AI model, saying it could reduce the amount of memory required to run large language models. Shares in SanDisk, Micron Technology, Western Digital, Seagate Technology, all falling anywhere between 3 and 6%. Elsewhere, Qualcomm up 1% despite Bernstein downgrading the stock to market perform from outperform, citing memory headwinds in the industry. And Adobe downgraded by William Blair to market perform from outperform, saying it's unclear at this point whether the stock is an AI winner or loser. However, shares are up by 2%. I'm Tucker Silva, and that is Wall Street Watch.
Mike, we got another week, another comment from former Goldman Sachs CEO Lloyd Blankfein. Saying, quote, this is in regards to private credit. At some point, there needs to be a forcing function or a reckoning that causes you to come to grips with what your balance sheet really is worth. The analogy I like to give is you accumulate tinder on the floor of the forest and eventually a spark will come, but the longer between intervals where there's a spark that sets it on fire, the more that accumulates. So basically saying, hey, there's some crap that's built up here and you need to flush it from the system, but it can be painful to do so. There's not really any specifics here, so I don't think that, there's anything that, he necessarily knows on this. And I want to touch on a few things that have been bothering me about just the way that private credit's been talked about in the last week or so. I'm no way, defending private credit, which I think has some very real problems they're reckoning with. But Apollo Group operates a large private credit fund. And they had requests for... what was it, Mike? I think it was 11% of funds to be withdrawn from it.
Yeah, something along those lines.
And this is it's through what's known as an interval fund, which basically on a quarterly basis allows investors to redeem 5% of these shares in the fund if they want to. After that, withdrawals are capped. That's the standard procedure for how they operate. And a lot was made this week that investors submitted requests for 11%, but, Apollo only let them get 5% out. That's how the fund is set up to function.
Right.
Even before any problems, that was the standard operating procedure for it, was to let 5% out because these funds, do keep, a little bit of liquidity. They often do have... some facilities that they can borrow against for that if they need to. They have income that gets kicked out. So, the 5% makes sense in that respect. They do have to go and sell some stuff, and they usually will start to sell off the higher quality stuff that they can get, better value for. But ultimately, it's something where, for all of the problems with private credit, the fact that a fund that always has had a 5% gate let 5% of assets out is not something I'm going to criticize them for.
Yeah, the other thing that I keep seeing, and part of this is because right now I just happen to be rereading Michael Lewis's The Big Short. Just I don't know why I decided to pick it up again, but I'm rereading it at the moment. And
is it because you're a little short?
Yeah.
Me too.
Nice.
Quite short.
That was fantastic.
But I'm rereading it right now, and probably that's influencing how I read some of these articles. But when I hear Blankfein warn of fire risks, I mean, it's the same terms that all of the authors post-GFC were describing things prior to, and the people that were shorting all of the, the entire subprime mortgage market were talking about it leading up to it. And again, I'm thinking it's just because you are talking about the guy who led Goldman Sachs during that period of time, so I think he's predisposed to talking about things in terms of fire risk. But if you go... One, if you're an investor that hasn't read The Big Short, like we talked about good books to, familiarize yourself with, that's probably one of them. It's also really entertaining and a very easy read, so you might as well. But the way that they are talking about it is in the same context of that, and they are really very, very different events in terms of, there's opacity that is consistent between the two of them, but that's really all that I can see in terms of similarities.
I mean, here's the thing, and this is the thing with private credit. None of us know how big the asset class actually is because it's private.
Yep.
The estimates are anywhere from like $3 to $6 trillion. It's kind of a big variation. Either way, that is smaller than the U.S. mortgage market, both at the time in 2008 and today. And so I think it's incredibly likely that you do not have a 2008 type scenario because of A, the size of it, B, who's holding this, and those are the main things.
Remember, too, though, during the 2008 mortgage market, it wasn't just the mortgage market that was being shorted. It was all of these synthetic derivatives that were created to mirror the mortgage market and effectively duplicated the exposure of the mortgage market on top of everything else.
Yes.
So there was a lot more in terms of just the measurement of the total outstanding debt.
But if you want to, here's where I think there's a key similarity that has some danger to the U.S. economy in terms of how it could play out. Back during the run-up to the what ended up breaking the mortgage market was banks eventually saying, no, we're not going to put any more money into mortgage-backed securities. Like we've got enough. And so that, in turn, dried up the market for new mortgages, which made it harder to sell properties, which made values fall further, which exacerbated the problem, and eventually everything just broke because the stuff had no value then.
Yeah.
That's not where you're going with this, because this is not the same fundamental issue. But you do have a lot of these mid-market businesses that they rely on private credit to buy inventory or to expand their business or whatever it might be. And when that funding mechanism dries up, it may result in a slowdown in the U.S. economy because these businesses can't expand the same way. And so it could represent a threat to the overall economic growth of the economy in that fashion, and in turn then exacerbate some of the problems in private credit through that same cyclical mechanism, because if the U.S. economy doesn't expand as quickly, then the companies that have borrowed, already done the borrowing to try to expand aren't going to see as much in the way of demand, and so the problem gets worse there.
Yeah, and the tentacles of it have reached, are far-reaching like it was during 2008, and I'll acknowledge that for a moment here, too, that, all sorts of buyers over the course of the last 5 years especially have been gobbling this stuff up under the assumption that it is infallible, not maybe infallible, but that it is good and lower risk than seemingly we're discovering right now.
So that's kind of where things stand with private credit. It's still we're watching, but no one knows how big the problem is. And again, I think it's something where you got to keep your antenna up for the next 12 to 18 months. Maybe I think we said earlier this week, hey, if you haven't seen problems by the end of next year, you can kind of start to put things to bed. But it's something where you just kind of have to watch and see how it develops. There's no other way to do it, and we'll just have to see what comes from it. I think that's kind of where it is. Let's take a quick break here, and when we come back, we'll talk about prediction markets and Congress. Are they going to get their act together to maybe prevent members of Congress from using prediction markets for trading? We'll discuss that next.
From market moves to retirement planning strategy, follow the Financial Exchange on Instagram and stay up to date on the business news of the day. This is the Financial Exchange Radio Network.
When going through a divorce, understanding the rules around your finances can make a real difference. This is Chuck Zodda from the Armstrong Advisory Group. State law plays a major role in how assets are divided, whether that means a strict split or a distribution based on what the court considers fair. Health insurance and Social Security benefits are other considerations that you'll need to prepare for. You may have been covered under a spouse's plan and now need to find one of your own, and Social Security may offer benefits based on your former spouse's record. Our new guide, Divorce in Your Financial Plan, will walk you through these issues and more to help you make informed decisions that may affect your future. Call 800-393-4001 to request your free copy. That's 800-393-4001 or request the guide online at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. Life estates are sometimes used to protect your home as part of your future, but it's important to understand how they really work before making any changes to your estate plan. Cushing & Dolan are experts in elder law and taxation. Their new guide, called Calculating the Consequences of Life Estates, explains the pros and cons and why careful planning is so critical. A life estate can allow you to remain in your home while transferring future ownership. But decisions like putting the property in your children's names versus using a trust can have very different consequences when it comes to taxes, control, and protection from creditors. Before you sign any deed or transfer property, be sure you understand your options. Call Cushing & Dolan at 866-848-5699 and ask for your free guide today. That's 866-848-5699. Or you can request the guide online by visiting LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
Sometimes we know what's next. Other times, it's impossible to know. Life can change in an instant. Don't be caught standing by the next time someone's heart stops. Knowing CPR gives you the ability to act and takes you from bystander to lifesaver. CPR is a life-saving skill. Join the nation of lifesavers today by learning CPR at heart.org/nation. National support for CPR education provided by Elevance Health Foundation.
Our Senators Edward Markey and Elizabeth Warren and Representative Ayanna Pressley are standing up for radio listeners like us by supporting legislation to keep AM radio in cars. They know the value of local radio in times of emergency. Now it's time for Congress to finish the job and pass the AM Radio for Every Vehicle Act. Learn more at dependonam.com. This message furnished by the National Association of Broadcasters and this station.
Environmental nonprofit Ocean River Institute is working with communities to tackle climate change with nature-based solutions that feature slowing water down and building more soil with grasses and plants. Research indicates that people acting in their own neighborhoods can build an inch of soil in a year and slow sea level rise down by as much as 25%. Please visit oceanriver.org for more information on opportunities to make a difference and go the distance for savvy stewardship of a greener and bluer planet Earth.
As a busy mom to 4 kids, my to-do list is full.
Trying to fit in exercise, eating right, and prioritizing self-care can feel next to impossible.
While we can't add more hours to the day, we do have a great resource to help.
Go Red for Women has easy tips, tools, and information to help you and your family live a healthier life.
So to all the moms, the aunts, the grandmothers, and amazing women out there doing it all,
visit goredforwomen.org/momlife today.
You take care of them, Go Red for Women will take care of you.
Missed a show? You can find them on our YouTube page. The show streams live every day, but every hour is archived, including all of our most newsworthy interviews. Go to YouTube and search for the Financial Exchange Radio Show.
All right, we got some news yesterday. A exclusive from Politico that, I'll quote here, lawmakers are introducing bipartisan legislation to prohibit members of Congress, the president, and others in the executive branch from trading in certain prediction markets, according to bill text shared exclusively with Politico. and basically it would be called the Preventing Real-Time Exploitation and Deceptive Insider Congressional Trading Act, the PREDICT Act, and it would prevent members of Congress from participating in prediction markets related to political events or policy decisions. It also says that the legislation would implement a fine to violators of 10% of the value of violating transactions, plus force any profits from those transactions to go to the U.S. Treasury, to which I say, this is nothing. Like, this is nothing. So here's the deal. First of all, it's not actually banning them from using prediction markets. It's trying to ban them from prediction markets related to political events or policy decisions. Aren't there like a million different ways that you can like finagle, oh, this wasn't a policy decision?
Yeah.
You know, like if you were to wager on the price of oil, is that not reflective of policy decisions right now?
Yes, it would be. And
But
you'd be able to argue that it wouldn't be.
Correct.
Yeah, this is, again, they're making this so complicated. The real solution is that anyone serving in Congress, anyone that works for a congressman or woman, anybody in the executive branch should not be able to trade, whether that is, whether that is equities, whether that is prediction markets. It's
corn futures, soybean futures, options on the moon.
I just don't care. This is the job you chose, and it comes with some reasonable restrictions to restore the faith of the American public that you are not just
in it for the money.
Yeah, I was going to use some bad words.
In it for the money.
Buy me dinner first.
So I think ultimately this is pure poppycock. It's hot garbage. It's a fine of 10% the value of the transactions. Why not 100? Why not 200? Why not 1,000,000%? Do you actually want to put down like a marker like, hey, don't do this? Or do you just want to be like, oh, well, we tried, like, gosh, golly gee willikers. So, look, I'm on the record. If you are serving anywhere near Congress or the White House or whatever, basically you should have access to whatever the funds are in, like, the TSP program. Like any government employees will tell you got, like, the G fund, the C fund, so on and so forth. Great. You can do that. If you want to be able to, execute trades at the end of a quarter in those limited sets of funds, fine, you can do so, in writing within, a 10-day period at the beginning of the quarter or something like that. Other than that, if you're going to be serving in a place where you have access to that kind of classified information, no, you should not be able to trade on it.
And
period.
Again, like, the evidence is so compelling here. Go look at lawmakers who sold stocks in, like, February of 2020.
Yep.
If you need the recent information, they had very clearly insider information about how bad the government response was going to be to COVID and sold their stocks because of it. Come on. They are screwing everybody else.
Many families consider using a life estate as part of their planning, but without a clear understanding, it can lead to unintended consequences. Cushing and Dolan have a new guide called Calculating the Consequences of Life Estates that explains what to watch for and how to think through your options before making any decisions. Key rules to be aware of include the 5-year Medicaid look-back, where the state reviews financial transactions over the prior 5 years, and certain transfers, like giving away property or assets, can create a period where benefits are delayed. Call Cushing & Dolan at 866-848-5699 to request your free guide today. That's 866-848-5699, or you can request it from their website, legalexchangeshow.com.
The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing and Armstrong do not endorse each other and are not affiliated.
Mike, the U.S. Postal Service is going to impose its first ever surcharge on packages related to fuel cost. It's going to be an 8% surcharge that begins on April 26th. That they will then plan to phase out on January 17th, 2027. Again, this will apply just to packages, not to regular letters that are delivered via first-class mail. And a few different thoughts on this that I have. The first is, we've seen energy prices spike before, so why is the post office doing this now?
Because they're broke.
That's the second question, which is, or the answer rather, well, it's an answer to the second question, which is, hey, is there anything about the post office's financial conditions now that's different from those other times? And the answer is, yes, there are, the post office's problems with, its revenue continue to be a growing problem.
Are you surprised that the White House is allowing this to go through?
We'll see if they end up actually doing it. This is pending approval of the, who is it? Hang on. There's a commissioner, something that this needs to be approved by.
You know what this feels exactly like to me? Do you remember in...
The Postal Regulatory Commission has to approve it.
It was second quarter of 2025, and Amazon decided they were going to start rolling out a price marker on how much the price increased due to tariffs and start, showing that as a line item on their sales. And a quick call from the president to Jeff Bezos, killed that within like 48 hours. This feels exactly the same to me.
So I've said for a while, like with certain things, I kind of wonder about it. Why do we care if the post office is profitable or not?
I don't have a good answer.
Like, there's no reason to. Like, we don't go, like, as an example, we don't go to the U.S. military and say, why didn't you turn a profit? Well, that's not our job. But why didn't you turn a profit? Well, our job's to, defend America. Yes, but can you do it with a profit? Like, no. Like, they have one job, and if you try to confuse that job with something else, then you lose, the functionality that you're trying to get out of, that particular branch. Likewise, if you were to go to, as an example, like the Department of Energy, most people don't realize that most of the DOE budget relates to maintenance and like decommissioning of anything nuclear. Like that's like what they actually do. You don't ask that the DOE turns a profit because you'd prefer that they don't blow up the nuclear material.
Yeah,
that's generally like how it works.
I'm not sure that the post office needs to run a profit. I do think it's reasonable to ask, like the mandate that they have of delivering to more than 170 million addresses 6 days a week. Is that a necessary mandate in 2026?
Yes, it is, in my opinion.
I disagree. I don't think
so. I'm going to stand up for the rural communities that don't have great connection to the rest of the country otherwise.
Yeah.
And like the ones they'd be talking about getting rid of, it's not, your suburban post office.
Right.
It's not your downtown, New York City post office.
Nope, it's out in Wyoming.
It's
and
out
Iowa.
in, Smoot, Wyoming, which has 400 people in it. And it's like, oh, now you're going to make things inconvenient from them because the post office needs to turn a profit for some reason. Let's take a quick break. We got hour 2 coming up in a little bit.
Life estates are sometimes used to protect your home as part of your future, but it's important to understand how they really work before making any changes to your estate plan. Cushing & Dolan are experts in elder law and taxation. Their new guide, called Calculating the Consequences of Life Estates, explains the pros and cons and why careful planning is so critical. A life estate can allow you to remain in your home while transferring future ownership. But decisions like putting the property in your children's names versus using a trust can have very different consequences when it comes to taxes, control, and protection from creditors. Before you sign any deed or transfer property, be sure you understand your options. Call Cushing & Dolan at 866-848-5699 and ask for your free guide today. That's 866-848-5699. Or you can request the guide online by visiting LegalExchangeShow.com. The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
Have you saved enough for retirement? This is Mike Armstrong from the Armstrong Advisory Group. The advisors at our firm have 150 years of combined experience in the financial services sector, and they all work together to help you develop a unique financial plan that offers investment management, financial planning, tax strategies, and retirement planning. It's our goal to help you position your assets and give you peace of mind. Having a solid retirement strategy and investment plan becomes more important as you age, so visit us today at armstrongadvisory.com and sign up for a free free, no-obligation planning session. Just click the Get Started button at the top right corner of the homepage, and you can select the day and time that works best for you. Go to ArmstrongAdvisory.com and let us develop a plan to help you secure your financial future. Again, that's ArmstrongAdvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
Environmental nonprofit Ocean River Institute is working with communities to tackle climate change with nature-based solutions that feature slowing water down and building more soil with grasses and plants. Research indicates that people acting in their own neighborhoods can build an inch of soil in a year and slow sea level rise down by as much as 25%. Please visit oceanriver.org for more information on opportunities to make a difference and go the distance for savvy stewardship of a greener and bluer planet Earth.
Our Senators Edward Markey and Elizabeth Warren and Representative William Keating are standing up for radio listeners like us by supporting legislation to keep AM radio in cars. They know the value of local radio in times of emergency. Now it's time for Congress to finish the job and pass the AM Radio for Every Vehicle Act. Learn more at dependonam.com. This message furnished by the National Association of Broadcasters and this station.
This is the Money Matters Radio Network. WBNW 1120 AM and W275CM FM. Concord, Boston. The Money Matters Radio Network.
When a heart stops, the clock starts. You are the first responder until help arrives. In that moment, 4 minutes equals brain damage. 6 minutes equals too late in an emergency. The first responder is you. We need you. Will you be ready? Learn CPR. Visit heart.org/nation. That's heart.org/nation.
Divorce isn't just a legal process. It's a financial reset. Hi, this is Mike Armstrong from the Armstrong Advisory Group, and our new guide, Divorce and Your Financial Plan, walks you through how to take inventory of your assets, avoid common mistakes when splitting accounts, update beneficiaries, and start building a plan that works for your next chapter. Divorce is complicated enough without all of its financial ramifications. The decisions you make now can have lasting consequences for your future, because after a divorce, it's not just about who gets what. It's about making sure your financial life is truly separated and set up to support your goals going forward. Call the Armstrong Advisory Group right now at 800-393-4001 and get your free guide, Divorce and Your Financial Plan. That's 800-393-4001 or request the guide online at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
Sometimes we know what's next. Other times, it's impossible to know. Life can change in an instant. Don't be caught standing by the next time someone's heart stops. Knowing CPR gives you the ability to act and takes you from bystander to lifesaver. CPR is a life-saving skill. Join the nation of lifesavers today by learning CPR at heart.org/nation. National support for CPR education provided by Elevance Health Foundation.
It happens all over Massachusetts.
Can you tie my shoes?
In every home and every community.
Be careful on your bike.
Learning can happen anytime, anywhere.
We'll see you at practice this weekend.
And no matter how learning takes place in your family's life, DESE is there as your partner. The Massachusetts Department of Elementary and Secondary Education. Never stop learning. Find out more at mass.gov/back-to-school.
Sponsored by the Massachusetts Department for Elementary and Secondary Education.
This is Michael Valila, Adjutant of the Disabled American Veterans Department of Massachusetts. We focus on the people returning from service, not their specific illness or injury. Our number one goal is to make sure our veterans have the necessary services they need, be it physical, emotional, or financial, so that their transition can be seamless. You can help our great American heroes as well by making a donation today by visiting dav5k.boston. That's dav5k.boston.
This is Tucker Silva of the Financial Exchange Show, and I'm joined today by estate planning attorney Todd Lutzke from the law firm of Cushing & Dolan with your Financial Exchange Quick Tip of the Day. And today, we're talking about the use of life estates and your primary residence. Todd, does the 5-year waiting period for Medicaid eligibility apply to the creation of a life estate?
Well, the short answer is yes, it does. But let me explain why it does. So, first of all, when you create a life estate, again, the general way people do it is they tend to put the remainder interest of the property in the hands of children. I don't like it that way, but that's how they do it, when you could have the remainder interest with the trust. But the moment you put the child's name on the deed and you reserve the right to live there is a completed gift for gift tax purposes. No one thinks of that, but now you technically need to file a gift tax return. And it's that creation of the gift, it's that transfer of that remainder interest in the property to the child for less than fair market value that triggers the disqualification period for Medicaid. So that's why you have to wait 5 years after you create this life estate arrangement in order for the house to be protected from the nursing home. It's very hard to avoid the 5-year waiting period, folks. There's really not too many ways around it.
Learn how you can avoid probate, eliminate estate taxes, keep your money in your family, and protect your assets from the nursing home. Request this brand new guide from Cushing & Dolan. It's called Calculating the Consequences of a Life Estate. You can get it by calling 866-848-5699. That's 866-848-5699, or you can simply request it from their website, legalexchangeshow.com.
The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Armstrong do not endorse each other and are not affiliated. The Financial Exchange is produced by Money Matters Radio and is hosted by employees of the Armstrong Advisory Group, a registered investment advisor. All opinions expressed are solely those of the hosts, do not reflect the opinions of Armstrong Advisory or anyone else. Investments can lose money. This program does not offer any specific financial or investment advice. Please consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong Advisory and the advertisers heard on this program do not endorse each other or their services. Armstrong and Money Matters Radio do not compensate each other for referrals and are not affiliated.
This is the Financial Exchange with Chuck Zodda and Mike Armstrong. Your exclusive look at business and financial news affecting your day, your city, your world. Stay informed and up to date about economic and market trends, plus breaking business news every day. The Financial Exchange is a proud partner of the Disabled American Veterans Department of Massachusetts. Help us support our great American heroes by visiting dav5k.boston and making a donation today. This is the Financial Exchange with Chuck Zodda and Mike Armstrong.
Chuck, Mike, and Tucker with you here, and we've got Why don't we just run that back? We've got markets off modestly today in equities, with the S&P down about 0.2%. The Dow was off about 0.1%. The NASDAQ composite feeling a little bit more pain, down 1%, about 221 points, as memory stocks continue, memory chip stocks, I guess, continue to get bludgeoned pretty convincingly over the last month or so, after being some of the best performing parts of the market previously. Semiconductors just are really having a tough go over the last month. Micron Technology in particular down another 5% today. This coming about a week or so after they reported earnings. Bonds, we got the 10-year Treasury back up 4.2 basis points to 4.37%. It appears in the last few days we found a little bit of kind of a tighter range to trade in between 4.3 and 4.4 on the 10-year after seeing it rally in terms of yields, moving up from about 3.95 to that 4.3 range over the prior 3 weeks. But a little bit of consolidation happening now. Is that consolidation before another move higher? Don't know. Is it consolidation before rates move back down? Don't know either. What I can tell you is the impact that's happening on mortgage rates is pretty consistent as well. We're back up into that 6.5% range from around 6, and we're kind of holding there with some wiggles depending on the particular day. Other things that are moving today, dollar index not moving a ton. up 0.18% to $99.58. Gold back down $90 an ounce to $44.61. And crude oil moving back up 3 to 4% depending on the metric you're looking at. West Texas Intermediate up $3.50 a barrel. Brent crude up $5.21 a barrel. And the AAA national average for gas prices coming in yesterday down 0.2 cents. I think that's the first downward move we've had since this kicked off. Diesel, though, continuing to move up another 0.9 cents to $5.37 and 5 tenths. So that's what's going on in markets. Anything catching your eye, Mike?
No, I mean, a lot of the country is going to be experiencing that $4 gas if this continues very soon, if they're not already. Obviously, West Coast is already there, but even here in the Northeast, we're pushing there. You know, we are getting fairly close.
West Coast closing in on 6, by the way. California is at 584 right now, which is the highest in the country. Any idea which state has the lowest in the country at the moment?
Usually, no, I don't know. Give it to me.
It's usually Louisiana.
Okay.
It's not right now. It's actually Oklahoma at the moment is at 325 per gallon. I think that's what they measure it in, right?
As far as I know, in Oklahoma they do it to. It doesn't change to like, I don't know, cowboy hat there.
You ever like? Sorry, this is a weird thing. So I was driving my car the other day, and you know, I was sitting at like a light or something. I was in traffic on 128, and I was like, okay, like, you know, you start flipping through like the settings on your car just to be like, is there anything interesting going on here since I'm not moving? And I had the option to change to the metric system.
Give some leaders.
I was like, ooh, this could be interesting. Like, yeah, you know, let's go from MPG to MPL. It doesn't go to MPL.
What does it do?
It goes to like liters per mile instead. So it's like flips it, and so I'm like, I don't know if this is good or bad, because I've you've just never thought of it that way. It would be like going to gallons per mile.
Wait, hold on. Does it do liters per meter?
No, it's liters per 100 miles. Sorry, liters per 100 kilometers. That's
per
what
100K. Yeah, okay, that would make some
and
sense.
I'm looking at it. I'm like,
that's too much math.
I'm like, I don't know how to do that. Like that's too much. Like let's quick hit the button and turn it back before this gets too weird. So that was my experience with the metric system last week.
Yeah.
It was not all it's cracked up to be. Let's talk a little bit about this piece from the Wall Street Journal. So Meta and YouTube have been involved in. There's actually been a couple of different cases for Meta, but they were involved in this case out in California where a jury found that Instagram's owner, Meta, and YouTube were both negligent for operating a product that harmed kids and teens and failed to warn about those dangers. So the jury ordered a $3 million penalty paid to the plaintiff, and the plaintiff basically had said, look, I used social media, while I was a teen, and it contributed to mental health issues, and nothing, was said about this, and nothing prevented me from doing this. And the jury also said that Meta and YouTube should pay another $3 million in punitive damages beyond the initial compensation awarded as well. And this was basically almost unanimous in terms of how it was done.
So the question, the obvious question that the Wall Street Journal, I think, asks is this a big tobacco type moment for social media companies? This is one lawsuit. There's a lot of discovery. It comes back. The similarities are, what did the companies know at the time that they were distributing this? And in the case of big tobacco, it was, hey, we are intentionally distributing free cigarettes in areas to children, full on knowing what the health ramifications are. And I think you can paint a picture where there's obviously some of that with companies like Meta.
Here's the tough stuff that you're going to have to sort through on this. Look, those of you who have listened to our show for years, you know that I despise social media with every fiber of my being.
Sure.
I especially like the companies that run it, I generally think are
deplorable.
I think they're uncouth.
Okay.
Well, no, that's not it. Here's what I think, that the companies don't actually care about the people that are on their platform in any way, shape, or form.
Mm-hmm.
And that's kind of where I land. The problem is, and look, I've seen all of the data showing, hey, ever since, 2010, mental health amongst, basically every demographic, but in particular, teenagers, has gotten worse. And I see this all, but, and look, I think with every fiber of my being, the smartphones are the problem, like coupled with like the apps that are on them, obviously. But it's also something where, in the case of smoking, like you could look at it and be like, hey, here are the lung cancer rates of smokers versus non-smokers.
Yeah.
There was, pun intended, a smoking gun.
And frankly, we have a system in our courts where you put a value on, like a dollar value on somebody's health condition, on somebody's life, right? We have insurance companies that actually have stated thresholds for, this is what an arm is worth. This is what cancer is worth. We do not have that same measurement tool for mental health issues, even when they do result in suicide and other terrible outcomes.
And part of that is just because they can evolve over time, and there's rarely one clear, definitive trigger for them. And so this is where I think this is going to become a problem in terms of comparing this to the tobacco lawsuits, because it's not the same for both of those reasons. What I do think is coming, and look, this is not just in being discussed in remote parts of the world at this point. Countries are going to start banning this stuff for people that are younger. They already are.
Australia already has.
But it's not just Australia. Like, it's expanding. Like, there's been 5 or 6 in the last couple months now that have talked about it. And it's not just like the usual suspects. Like, I think India was one of them. I forget who. Like, there's been a couple other ones that you're like, oh, like, wasn't expecting to see that there. You figured it'd be like, oh, like France is going to do this, or like the UK is going to do this. It was like some ones that you go, that made me think about it. And so I think where we are heading is that you are going to see more bans of social media use for young people. The question is, how effective do those bans, actually become? But the other thing that I will say, you look at the polling about social media that is, directed at young people. And pretty much, like, if you read it, it's pretty consistent that all of them wish that they weren't on it, but all of their friends are, and so they feel like they have to be.
Yeah. The second lawsuit, Chuck, that we didn't talk about was the $375 million penalty awarded in New Mexico, which found Meta liable for failing to protect young people from sexually explicit content, solicitation, human trafficking. Again, deplorable. I find Meta morally guilty on all of this, but that one especially seems as though they've got a pretty good Section 230 argument on. I don't know, but like if you're going to appeal it, right, the entire idea of Section 230 is, as disgusting as it might be, Section 230 says Facebook's not responsible for any of the content that other people post, and Facebook was not the one doing the soliciting. So as morally repugnant as I find that, I have some big questions about that.
Now, the other thing that I will say that's interesting about Meta is, well, there's a few things. Number one, they're getting rid of the metaverse. We covered that last week. They're de-metavizing, I think is the technical term. The other thing that came out last week is that they're trying to pay a bunch of like TikTok and I forget where else influencers to post on Meta instead of on those other platforms, which I come back to. Look, if you have to pay those people to post there, it's a sign that you're kind of losing ground with the key constituency. Like, the 13 to 17-year-old demo doesn't want to hang out on the same platform as their grandparents.
Right.
Sorry, that's just how it is. It's not you, it's you. It's just like, that's the deal. Like, teenagers don't want to hang out on social media with their parents and grandparents. And so, ultimately, I think the interesting thing to me is going to be, look, the longevity of these companies is an interesting question to kick around, because for all of their existence, I mean, Meta, for as big of an influence as it has now, it's been around for 21 years, maybe 22. I think it was 2004 is when it was founded. It hasn't actually gone a full generation yet of like, hey, can we continue to be cool enough for everyone to go there and the network effects be strong enough for people to continue beyond, the initial population. And so I think that'll be something that's just interesting to watch on all of these, which is, hey, there's always a new cool one, and Meta to this point has been impervious enough to it, largely through buying up their competition so that no one else can compete with them. But at some point does that end when like future generations are just like, no, you guys kind of suck, and I'd prefer not to suck with Zuck. Like let's go somewhere else.
Ooh, it rhymes too.
I know. Let's take a quick break. We've got trivia after this, and then we'll talk about other things.
Stay connected between shows. Follow the Financial Exchange on Instagram for daily clips on business news from New England and around the country. This is the Financial Exchange. Protecting your home at the life estate can be problematic if you don't understand the rules. Cushing & Dolan's new guide called Calculating the Consequences of Life Estates can help you learn about how this strategy works and what to consider. Call Cushing & Dolan at 866-848-5699 and get your guide today. Or request it online at LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
Hi, I'm Michael Valila, Adjutant of the Disabled American Veterans Department of Massachusetts. The DAV of Massachusetts provides thousands of hours of voluntary services at our VA medical centers and soldiers' homes and is the only DAV department in the country to lead a veterans housing initiative for both single veterans and those with families. These programs are critical to serving our veterans in their time of need. You can help our great American heroes by making a donation today. Please visit dav5k.boston. That's dav5k.boston.
As you navigate life after divorce, planning for your family's future becomes even more important. Hi, this is Mike Armstrong from the Armstrong Advisory Group. From everyday expenses to thinking about how college will be funded, it's important to have a clear plan for how all of your upcoming costs will be handled over time. Divorce also means adjusting to a new financial reality, where one household becomes two and your budget, saving strategy, and long-term goals may need to be reevaluated. Our new guide is called Divorce and Your Financial Plan, and it discusses ways to build a financial strategy that supports your family's next chapter. You can get your free guide today by calling 800-393-4001. That's 800-393-4001, or you can request the guide online at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
Environmental nonprofit Ocean River Institute is working with communities to tackle climate change with nature-based solutions that feature slowing water down and building more soil with grasses and plants. Research indicates that people acting in their own neighborhoods can build an inch of soil in a year and slow sea level rise down by as much as 25%. Please visit oceanriver.org for more information on opportunities to make a difference and go the distance for savvy stewardship of a greener and bluer planet Earth.
It happens all over Massachusetts.
Can you tie my shoes?
In every home and every community.
Be careful on your bike.
Learning can happen anytime, anywhere.
We'll see you at practice this weekend.
And no matter how learning takes place in your family's life, DESE is there as your partner. The Massachusetts Department of Elementary and Secondary Education. Never stop learning. Find out more at mass.gov/back-to-school.
Sponsored by the Massachusetts Department for Elementary and Secondary Education.
Here at the Massachusetts Department of Elementary and Secondary Education, we are committed to all students not only attending, but succeeding at school. Your presence is powerful. Share why you attend at doe.mass.edu.
Sponsored by the Massachusetts Department of Elementary and Secondary Education.
Our Senators Edward Markey and Elizabeth Warren and Representative Stephen Lynch are standing up for radio listeners like us by supporting legislation to keep AM radio in cars. They know the value of local radio in times of emergency. Now it's time for Congress to finish the job and pass the AM Radio for Every Vehicle Act. Learn more at dependonam.com. This message furnished by the National Association of Broadcasters and this station.
Get real-time financial insight as news breaks. The Financial Exchange is live on X. Watch the show and follow us for the most up-to-date business news you need to know. This is the Financial Exchange.
Time for trivia here on the Financial Exchange. And on this day in 1920, F. Scott Fitzgerald's first novel, This Side of Paradise, was published. The popularity of the book immediately launched 23-year-old F. Scott Fitzgerald to fame and fortune. So our trivia question today, which novel is considered F. Scott Fitzgerald's masterpiece? Once again, which novel is considered F. Scott Fitzgerald's masterpiece? Be the fifth person today to text us at 617-362-1385 with the correct answer, along with the keyword trivia. You win a Financial Exchange Show t-shirt. Once again, the fifth correct response to text us to the number 617-362-1385 with the correct answer, along with the keyword trivia, will win that t-shirt. See complete contest rules at financialexchangeshow.com.
Better question. What is F. Scott Fitzgerald's actual first name?
Frank.
Close.
It's just F.
Francis?
Yes, it is Francis. Do you know why he goes by F. Scott Fitzgerald?
No.
Do you know what his full name is? No. I'm going to tell you.
I would hope so. Stop asking me questions.
Francis Scott Key Fitzgerald. Now, where else do we see a Francis Scott Key?
Yeah.
Not just on the bridge in Baltimore.
Yeah.
Which, by the way, is finally being rebuilt. But none other than who wrote the Star-Spangled Banner.
Yeah.
So there's that. The more you know. Let's talk about this piece from the Financial Times. Stagflation is back. Well, I don't think so.
I'll debate you. Maybe not in the U.S. yet. This isn't necessarily just written from a U.S. perspective. Plenty of countries are probably experiencing stagflation as we speak.
Yeah, that's fine.
Yeah,
in the U.S., it's not.
Yeah, U.S., we're not there.
No.
Plain and simple, we are not there. I guess, can we set, we talk about these things hypothetically. We talked about, setting a benchmark for how do we define recession, all these things. How are we going to define stagflation? Because there is no, there's a clear term for recession. There's a clear, marker for it. Mm-hmm. How are we going to mark stagflation?
I'm going to do it like the Supreme Court does with pornography. You know it when you see it.
That's no good.
It's what it is. Here's the thing. The U.S. economy right now is probably growing pretty close to at a 0% rate at this very moment in time. But that's because of the changes in the composition of the labor market that prevent it from growing faster. It's probably growing as quickly as it can, given the demographic shifts that are happening in the labor market. We've seen this with how the Q4 number was revised down to, 0.7%?
Yeah.
Q1, if you look at GDP now from the Atlanta Fed, I haven't looked at it in a while, it was tracking 2% as of March 23rd. I'm going to take the slight under on it because the data's evolved since then. And we still have another month of data that obviously we're going to get on Q1. So you probably have, for the last 2 quarters, U.S. economy growing somewhere around 1%. In general, historically, we'd say, given that inflation is probably going to be, touching the high 3s within the next month or two, hey, that's kind of stagflationary, inflation at 3.9 and GDP growth at 1. I'll make the case that it's inflationary, but the stag is missing at the moment because the labor market, and I'm very much on the same camp as Jay Powell on this now, the labor market can't grow any faster because you got a bunch of baby boomers retiring, and immigration on a net basis is probably close to 0 right now.
Yeah. So we can all agree that the 1970s was defined by stagflation. Perfect example of stagflation, 1970s, vast majority of it, different periods of stagflation.
And just one more thing, sorry to interrupt. The unemployment rate's still in the 4s.
Yeah.
It's tough for me to call it staggy if you're in the 4s on the unemployment rate.
So, okay, no, when you see it, 2022, stagflation or no?
Yes.
Unemployment didn't move.
What's that?
Unemployment wasn't a problem.
Unemployment was a problem. It was just coming off a very low baseline.
Yeah. See, this is why I struggled without a definition, right? 1970s, you had several different periods, most of a decade that you would define as stagflation. Best case, 2022, if you're trying to meet that definition, what did it last, 6 months?
Yeah, it was the first half of the year, really.
Yeah.
Yeah. So, again, I don't think there is a formal definition because it's all relative to where you were before. Yes, unemployment wasn't high in the first half of 2022, but the real economy was decelerating incredibly quickly, And you were starting to see that pass through to the labor market. It was just coming off of the hottest labor market that we've ever seen. So right now, in this environment, Mike, here's how I would say that the U.S. has become stagflationary. If unemployment gets to 5.5 and inflation is over 4, stagflation this year.
I was going to say, I think that I am willing to only call it stagflation if you have a declared recession combined with inflation over 4.
Give me a 1% rise in the unemployment rate and in the
in which case
rate.
You're probably getting a declared recession there. If you
Probably. Well,
like,
not necessarily. So here's the thing. Like, there's all kinds of weird stuff going on. Like, I've been paying attention to the trucking market in the last month. Because even before any of the, like, even factoring in what we're seeing in terms of diesel prices, the trucking market is insane right now in terms of needing capacity because there's just a ton of demand moving stuff back and forth. And so, like, that's indicative of an economy that may actually be heating up. So there's a lot of different signals right now. I don't think they're pointing stagflationary in the U.S. Quick break. Trivia answer next.
Bringing the latest financial news straight to your radio every day. It's the Financial Exchange on the Financial Exchange Radio Network.
Our Senators Edward Markey and Elizabeth Warren and Representative Lori Trahan are standing up for radio listeners like us by supporting legislation to keep AM radio in cars. They know the value of local radio in times of emergency. Now it's time for Congress to finish the job and pass the AM Radio for Every Vehicle Act. Learn more at dependonam.com. This message furnished by the National Association of Broadcasters and this station.
This is Michael Valila, adjutant of the Disabled American Veterans Department of Massachusetts. The DAV of Massachusetts has helped me and countless others adjust to civilian life through a variety of incredible programs. Through our local Veterans Assistance Program, we provide necessary services to veterans and their communities, such as food shopping, landscaping, and companionship, but we need your support. You can help by making a donation today. Please visit dav5k.boston. That's dav5k.boston.
When going through a divorce, understanding the rules around your finances can make a real difference. This is Chuck Zodda from the Armstrong Advisory Group. State law plays a major role in how assets are divided, whether that means a strict split or a distribution based on what the court considers fair. Health insurance and Social Security benefits are other considerations that you'll need to prepare for. You may have been covered under a spouse's plan and now need to find one of your own, and Social Security may offer benefits based on your former spouse's record. Our new guide, Divorce in Your Financial Plan, will walk you through these issues and more to help you make informed decisions that may affect your future. Call 800-393-4001 to request your free copy. That's 800-393-4001 or request the guide online at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. Life estates are sometimes used to protect your home as part of your future, but it's important to understand how they really work before making any changes to your estate plan. Cushing & Dolan are experts in elder law and taxation. Their new guide, called Calculating the Consequences of Life Estates, explains the pros and cons and why careful planning is so critical. A life estate can allow you to remain in your home while transferring future ownership. But decisions like putting the property in your children's names versus using a trust can have very different consequences when it comes to taxes, control, and protection from creditors. Before you sign any deed or transfer property, be sure you understand your options. Call Cushing & Dolan at 866-848-5699 and ask for your free guide today. That's 866-848-5699. Or you can request the guide online by visiting LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
Hey, this is Mike Armstrong and Paul Lane from the Armstrong Advisory Group, and we're here to talk to you about our brand new guide, Divorce and Your Financial Plan. Paul, let's fast forward here a moment. You're through the divorce process, and now you are focused on this entirely new financial life. What do you view as the first step toward developing that new financial plan as you're thinking about a single individual versus a married couple?
What you really have to focus on, Mike, is the cash flows of your household. You've gone from presumably 2 incomes down to 1 income, or you're just living off of a lesser income. So understanding what your expenses are going to be going forward and matching that to the income that's coming in to your newly formed household is really important. That is something that is a area of significant focus, as well as health insurance coverage is another area that is of significant importance.
How are things like taxes and general expenses, how does that all change now if you're thinking about a single person versus a married couple?
Yeah, the tax brackets will change for a single filer versus a married couple. Usually to the downside, really, you're going to pay more in the way of taxes. So that's something that's really important to focus on, as well as many other areas of your financial plan.
Folks, we've got a brand new guide, again, from the Armstrong Advisory Group. It's free, and it's available at armstrongadvisory.com. You can request it there. It's Divorce and Your Financial Plan. There is a lot that goes into rebuilding your financial life after a life event as consequential as a legal divorce. If you have questions about how to navigate that process, this new free guide from the Armstrong Advisory Group is a great starting point. You can get it by requesting it again at armstrongadvisory.com or calling us at 800-393-4001.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. Time now for Wall Street Watch, tracking the stocks, the data, and the headlines driving markets so far today, right here on the Financial Exchange Radio Network.
Markets remain volatile and are now selling off after President Trump threatened this morning to escalate the conflict with Iran after Iran rejected Washington's push for peace talks. Right now, the Dow down 0.4%. S&P 500 down over 0.8%, NASDAQ down 1.2% or 267 points. Russell 2000 down over 0.75%. 10-year Treasury yield is up 5 basis points at 4.384%, and crude oil jumping 4% higher, trading at $94 a barrel. Both Meta and Alphabet were recently dealt a blow in a landmark addiction trial where an LA jury found that Meta and YouTube were negligent for operating a product that harmed kids and teens and failed to warn about those dangers. Both Meta and Alphabet plan to appeal the verdict. Those stocks down 5% and 2% respectively. Meanwhile, several memory chip makers seeing losses on the day after Google revealed its new AI model, saying it could reduce the amount of memory required to run large language models. SanDisk, Micron Technology, Western Digital, Seagate Technology, all falling anywhere between 3% and 7%. Elsewhere, Qualcomm is up over 1%, despite Bernstein downgrading the stock to market perform from outperform, citing memory headwinds in the industry. And Adobe, downgraded by William Blair to market perform from outperform, saying it's unclear at this point whether the stock is an AI winner or loser. However, shares are up by 2% at the moment. I'm Tucker Silva, and that is Wall Street Watch. And in the previous segment, we asked you the trivia question: which novel is considered F. Scott Fitzgerald's masterpiece? That would be The Great Gatsby. Ryan from Westboro, Mass. is our winner today, taking home a Financial Exchange Show t-shirt. Congrats to Ryan. We play trivia every day here on the Financial Exchange. See complete contest rules at financialexchangeshow.com.
Mike, we got a piece from Bloomberg. Investors switch to cash from stocks and bonds like it's 2022. And
is it true?
Not really.
I don't even know where we turn to evidence for how much cash individual investors are holding.
I do like the Bank of America does a fund manager survey that they do every week. And their one from March 6th through 12th showed cash levels went up to 4.3% of the portfolio. I'm sorry, they do it every month, from 3.4% in February. But that compares to 5.9% following the invasion of Ukraine and also during the pandemic. So, no, like the data there is telling you that fund managers are not, allocating to cash the same way they were back in 2022 or in 2020. And I think that when we look at even the data from JP Morgan, where they look at basically, they try to figure out the implied amount of cash relative to equities and bonds that non-bank investors have, basically like the average person. And they're still showing that relative to, again, like what's invested in stocks and bonds and things like that, we're basically still sniffing the lowest levels ever.
Let's frame this in terms of bonds for a moment, Chuck, because frankly, I think most people have a pretty good semblance of an idea of stock invest. They might not know like how to trade options and sector by sector, but I think generally speaking, people understand that sometimes stocks take a big hit, and it can oftentimes coincide with unpredictable events like war, like recession, etc. I don't find that knowledge carries over to bonds. So I think there could be some recent bias in all of this, but can we talk about the conditions that led to the worst year for bonds since the 1970s 4 years ago? Because I do find that to be very relevant for investors today.
So 2022, heading into the year, if you take a look at where things were, we were in a situation where effectively closing out 2021, the 10-year finished it off at about 1.51%. Over the course of 22, it then went from that 1.51%, peaking at 4.33 in October, and then even in 23, things got worse as it headed up to 5% by October of 23. But in 22, you saw yields rise about 3% over the course of the year on the 10-year Treasury. And remember, when yields go up, bond prices go down. And the reason is simple. Mike, if I lent you $100 and I said, okay, great, I want you to pay me back that $100 with, $2 by the end of the year, you'd say, great, that's, 2% interest I'm going to pay you, that sounds fine. And if you went to go unload that to someone, you'd get that fair market value of, basically par, $100, because that's what's out there. But now assume that interest rates go up 3%, and you're sitting there and you're like, man, I'm only getting 2% on Chuck's bond. I don't want to hold that anymore, because Jimmy over there is willing to give, Jimmy, or I forget who's lending the money. But in any case, someone's saying, hey, now I can give you 5%. And so the bond that you're holding, Mike, it's not worth $100 anymore. It's going to be worth whatever the number has to be in order to get the yield equivalent to that 5. Because if there's 5% bonds on the market, all else being equal, yours has to go down in value to make the yield look the same.
For 30-plus years, inflation was a concern for investors, but was honestly not really a phenomenon that investors turned out to need to worry about. And in 2020s, it has, at least once so far, become a real issue for investors, and some thinking about how it could become an issue again. If it does occur, it can mean big ramifications for both stocks and bonds. And if you are trying to sort through what it might mean for, again, what most people perceive as the conservative or safety bucket of their portfolio. That's why the average investor, at least, invests in bonds in the first place. If you're trying to sort through what that all could mean for that, bucket of your retirement plan, give the folks at Armstrong Advisory Group a call and let us work through how your investments are set up for your financial future. The number is 800-393-4001. There were big lessons to be learned from the inflationary environment of 2022. And if you're unsure if your portfolio is poised to deal with that type of situation again in the future, give us a call so we can walk you through it. The number again, 800-393-4001.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
Piece in the Wall Street Journal, are bots replacing workers? These skeptics aren't so sure. And it talks about these announcements from companies recently where they've cut large percentages of their headcount saying, hey, we can automate this with AI. Here's the case I made at the time when some of these announcements were coming out. I think it was Block a few weeks back, and I forget who the other one was that put something out similarly. They probably are going to use AI to replace some of this, some of the work that's being done.
Mm-hmm.
But a lot of these companies hired way too many people back in 21 and 22. tried to get rid of them through attrition over the last few years by, return to office mandates and things like that. And now we're finally getting to the point where they're like, we overhired, we got to get rid of these people, and we're just going to do it. It's a combination of those two.
Yeah, there's going to be a lot of AI washing in the meantime. Eventually, I do agree that all sorts of jobs are likely to be automated away, but very few of them have been to this point. And so, beware of the executive that's saying we laid off all of this stuff because of the phenomenal productivity increases from AI. I don't think there's a ton of evidence of that yet.
I do think there's evidence that companies are seeing productivity increases from AI, but I don't think there's evidence they're laying people off in meaningful numbers because of it yet.
Right.
So I think both of those things can be true at the same time. Let's see. I don't want to talk about CPUs. That seems just too nerdy to me right now.
Deal.
I do want to talk about housing. So you've got this bill in the Senate that is, I'll quote here, one of the provisions among the 40 bills that make up the 21st Century Road to Housing Act would curb the role that institutional buyers play in the housing market, and that includes the build-for-rent industry. It would set new restrictions on investors who own 350 or more single-family rental homes, requiring them to sell newly built units to individual owners after 7 years or face stiff fines. So if there's one thing that I know about anything, it's that when you try to control at a micro level who can buy or sell a certain product, you usually screw it up.
Yeah. I'm trying to think through the logical ramifications of this one, other than a lack of building. One of them is going to be that every builder would probably start focusing on, rental duplexes instead of single-family homes. Like, how can you basically build a single-family home that's not technically a single-family home is what they're going to focus their efforts on.
Yeah, it's going to be, okay, how do we end up, doing that? And look, I'm very pro-duplex, but this isn't also going to do...
I'm imagining a single-family home that is just attached by, like, a dryer vent or something like that. So they don't even share a wall. It's just attached by, like, some little tube that technically make it... Like, they share an HVAC unit, and therefore it's considered a non-single-family home.
Yeah, it's got ductwork underground that connects them in some way, shape, or form.
Don't do this.
Look, guys, if you want to make more homes, then make more homes. Like, this is the problem, and I'm going to go now to this piece from the end here. It's about Napa Valley, which the wine's great, the zoning, not. Here's the deal. They are trying to build more houses in Napa Valley. And
not near French Laundry.
Right, specifically, like, down the street from French Laundry, which is Thomas Keller's really expensive Michelin-starred restaurant.
Just a caveat here for a moment. I went to look at, like, that would be really cool to go to French Laundry. Would you like to guess? It might have been a special event at the moment, but would you like to guess the per person? It's all prefix menu. What it costs?
I think it's $1,800.
It was $1,500 like 3 years ago when I went to look at it per person.
Seems totally reasonable. So
I'd do it.
No, I'm sure the food's quite good. Don't get me wrong, but it's like
draw the line somewhere, folks.
Yes. So in any case, not all of, but a lot of Napa, including Chef Thomas Keller, who, again, by all accounts, like one of the best living chefs alive, is basically like, no, you can't build this 120-unit complex for these studio apartments there.
Of course not.
And the arguments that are being made against it are like, oh, these are going to be too small. Who would want to live that way? Well, why don't you let the market figure it out? And if they're too small, then they won't sell, and you can knock the thing over. So, like, that seems pretty reasonable. And, they're like literally, nobody wants to live in a cage. Well, then, okay, if no one wants to live there, it won't make any money, and you can knock it down.
If you want to just say it, just say you don't want poor people near you.
Right.
That's like, just stop dancing around it. That's what you're trying to say in a silly, eloquent way. You just got to come out and say it. Yeah, I don't want poor people near my restaurant. If that's what you want to say, go say it. I think it's wrong. I think it's stupid. But that's the argument that you're trying to make in a, silly kind of way.
So ultimately, the problem is that we don't build enough housing, and it's always, well, I can't have this near me. And it's like, guys, like, you can't. Here's the thing I always say. You can't simultaneously complain about your property taxes going up if you don't allow for new construction. That's the deal. You get to do one or the other. You can complain about your property taxes, or you can prohibit new construction. You cannot do both.
Them's the rules.
I don't make them, but I just did. Let's take a quick break. When we come back, we'll make some new rules and do some stack roulette right after this.
Daily financial content in your feed when you want it. Follow the Financial Exchange on Instagram. This is the Financial Exchange.
As you navigate life after divorce, planning for your family's future becomes even more important. Hi, this is Mike Armstrong from the Armstrong Advisory Group. From everyday expenses to thinking about how college will be funded, it's important to have a clear plan for how all of your upcoming costs will be handled over time. Divorce also means adjusting to a new financial reality, where one household becomes two and your budget, saving strategy, and long-term goals may need to be reevaluated. Our new guide is called Divorce in Your Financial Plan, and it discusses ways to build a financial strategy that supports your family's next chapter. You can get your free guide today by calling 800-393-4001. That's 800-393-4001, or you can request the guide online at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. Life estates are sometimes used to protect your home as part of your future, but it's important to understand how they really work before making any changes to your estate plan. Cushing & Dolan are experts in elder law and taxation. Their new guide, called Calculating the Consequences of Life Estates, explains the pros and cons and why careful planning is so critical. A life estate can allow you to remain in your home while transferring future ownership. But decisions like putting the property in your children's names versus using a trust can have very different consequences when it comes to taxes, control, and protection from creditors. Before you sign any deed or transfer property, be sure you understand your options. Call Cushing & Dolan at 866-848-5699 and ask for your free guide today. That's 866-848-5699. Or you can request the guide online by visiting LegalExchangeShow.com. The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
Environmental nonprofit Ocean River Institute is working with communities to tackle climate change with nature-based solutions that feature slowing water down and building more soil with grasses and plants. Research indicates that people acting in their own neighborhoods can build an inch of soil in a year and slow sea level rise down by as much as 25%. Please visit oceanriver.org for more information on opportunities to make a difference and go the distance for savvy stewardship of a greener and bluer planet Earth.
As a busy mom to 4 kids, my to-do list is full.
Trying to fit in exercise, eating right, and prioritizing self-care can feel next to impossible.
While we can't add more hours to the day, we do have a great resource to help.
Go Red for Women has easy tips, tools, and information to help you and your family live a healthier life.
So to all the moms, the aunts, grandmothers, and amazing women out there doing it all,
visit goredforwomen.org/momlife today.
You take care of them, Go Red for Women will take care of you.
Protecting your home at the life estate can be problematic if you don't understand the rules. Cushing & Dolan's new guide called Calculating the Consequences of Life Estates can help you learn about how this strategy works and what to consider. Call Cushing & Dolan at 866-848-5699 and get your guide today. Or request it online at LegalExchangeShow.com. The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
Hi, I'm Michael Valila, Adjutant of the Disabled American Veterans Department of Massachusetts. The DAV of Massachusetts provides thousands of hours of voluntary services at our VA medical centers and soldiers' homes and is the only DAV department in the country to lead a veterans housing initiative for both single veterans and those with families. These programs are critical to serving our veterans in their time of need. You can help our great American heroes by making a donation today. Please visit dav5k.boston. That's dav5k.boston.
The Financial Exchange is live on SiriusXM's Business Radio Channel 132, weekdays from 11 to noon. Get the latest business and financial news from across the country and around the world, and keep up to date on how it might affect your wallet. That's the Financial Exchange, weekdays from 11 to noon on SiriusXM's Business Radio Channel 132. This is the Financial Exchange Radio Network.
Hey, if you got questions for Chuck and Mike, you can participate in our Money Matters mailbag segment tomorrow on the show. If you have a question for the guys, just leave us a voicemail at 339-4333. Once again, that number to leave a voicemail for the Money Matters mailbag, 339-399-4333, or email your question over to tfeshow@gmail.com, and we may use it on the show.
Mike, what do you got for Stack Roulette?
AI, and specifically this time in movies. So a fake Val Kilmer is due to premiere or due to show up in a new movie called As Deep as the Grave. Apparently he expressed a lot of interest in the script and the movie, but passed away in April of last year. And according to allegedly his family and wishes, they are comfortable with effectively, AI-generated content of him continuing to star in the film. And I feel a few ways about this, but the main thing I feel about it is that I have no interest in watching a movie where AI-generated dead actors are appearing in them. Maybe it's something that society gets comfortable with eventually. It's just not something that I feel great about.
No, I mean, ultimately, look, the value of any art, and I'm not talking just about like the monetary value, but the reason why any type of art has meaning is because of its limited supply. Okay. There's only so many projects that an artist can do during the course of their lifetime, and so what they choose to work on is an expression of what's important to them and what message they're trying to get across. If you lose that through just being able to generate unlimited videos or unlimited paintings or unlimited whatever in the style of artist X, that's not going to be interesting or useful to people. Beyond that, part of the reason that people care about movies is because of the actual people performing. I mean, for better or for worse, celebrities are celebrities because we get interested in them.
Right.
No one right now is like, Mike, how many people do you know that are big Vincent Van Gogh fans? Not like of the art, but of the person.
Not a ton.
There's not many. Like, Vincent Van Gogh does not get, like, 18-year-olds screaming. It's something where, ultimately, the Beatles did because it was like, oh, look, there's 4, like, cute British guys. Like, look at all of them. Like, they're great. And so I think part of it is also the idea that, hey, there's an actual person here. If that is not a person who's alive anymore, I don't know that we have the interest because there's just nothing there. And I got to be honest. Look, we're all going to die. Like, I know that I know that in America Probably. We have this like real problem with dealing with death, and so like we Botox the heck out of ourselves and do this and that to pretend that we're not like getting older. But this is just the next extension of it. It's like trying to like preserve ourselves after, and it's just too much, man. I'm sorry, and love Val Kilmer, like again, like fantastic actor, but. I don't know about this, man. Yeah. I just don't know.
Yeah.
That's where I am. Let's see. What else do we have to get through? Did you know that today is opening day for Major League Baseball?
I thought it was yesterday, but okay.
Was it yesterday?
Yeah, it was last night on Netflix.
And they've got a new AI-generated strike box.
Today's like the first like real day, though, like when most teams are playing.
Yeah, this is the big one, yeah.
March is too early for baseball. Full stop. Like, starting in April...
Where you're laying down the rules, huh?
I'm sorry, you can't have baseball in March that's regular season baseball. It's just not appropriate. And that's all I have to say about that. Markets remain broadly negative at the moment. We'll see if we get a rally before the end of the day. And we'll check in with you tomorrow. Or rather, you should check in with us to see if they rally before the end of the week. We'll see you then.
As you navigate life after divorce, planning for your family's future becomes even more important. Hi, this is Mike Armstrong from the Armstrong Advisory Group. From everyday expenses to thinking about how college will be